Welcome everyone to another episode of Cycles TV. Today we have a special episode and we have a special guest today. So we will have John Bollinger with us today, and I'm very happy to have you here, John. Welcome, John.
Oh, thank you very much for having me. It was a pleasure to be here.
Yeah, so and not just here, so we are also pleased that you will join our conference Cycles in the City in New York at end of May. So we are very pleased to have you there and also then meet in person to have a real talk about cycles and technical analysis. So thanks for supporting the foundation.
I'm really looking forward to the conference. There are a lot of people there that I want to meet and chat with. I think the thing about these conferences that people don't really think about that much is that they look at the list of presenters and such like that, and they say, oh, I want to see this one, that one, the other one. But the real opportunities for me is the opportunities to meet and greet and chat with other people like-minded and exchange ideas. It's really a great opportunity. I think people need to think about these conferences that way.
That's true, and we had a very great one last year, so we will just continue that series. It's a 3-day gathering with real experts on site, and as you said, just meeting person in person. You cannot do that virtually or by listening to just a talk.
Often the best bits are in the bar afterwards, but there we go.
That's also planned. So we will meet us there. So thanks. But before we come to the conference, maybe let's walk through a little bit the topics and the methods. And John, I mean, most people know you around the Bollinger Bands, for sure. But today, I like to explore a little bit your background on your work, which is also related maybe a little bit to cycles. So I mean, the Bollinger Bands are known by everyone now. We don't need to discuss the details, but for example, in the introduction of your book, while you explain how you developed those bands, you walk through, I think, 7 historical different approaches how bands could apply it to price series. And one of that approach was from Hurst. And Hurst also had an approach to plot envelopes around price by using his cycle detection and then plotting the envelope based on the cycle length and the amplitude. So what was it that caught your attention also to bring that approach into your story, or has it influenced your work while developing your approach?
So, back in those days, we were using fixed width trading bands. We'd take typically a 21-day moving average and shift it up and down by some percentage. For something like the Dow Jones Industrial Average, it was typically 4.5%, something in that range. And as market conditions changed, as you perfectly well understand, we would need to adjust the width of those bands. So in trading range markets, you'd need to tighten them up. And in markets that were trending strongly, you'd have to expand them. And the idea was to compare price action in relation to the bands to indicator action. So the whole idea of trading bands is they define prices. The price is high or low on a relative basis. By definition, price is high at the upper band, price is low at the lower band. And the problem that occurs to most people is that if they're bullish, they paint the bands to be bullish picture, and if you're bearish, you paint the bands in bearish picture. So you let your emotions into the puzzle. And we all know that emotions are the worst thing for investors. So I was looking around for a way to set the bands automatically so that I wouldn't have to have anything to do with it. They would be set. And one of the ways that I explored was Hurst's method. But frankly, you're an engineer, I'm not. And the math in order to make that real on a computer was beyond me at the time. We're talking the very early 80s. So we're talking, rudimentary PCs and maybe a language like Microsoft Basic or something like this. So I was never able to do that. I knew some other people at the time who'd done some work on Hurst on mainframe computers and such like that, Fortran and other languages that were more amenable to that sort of work. But that was beyond me. And at the time, I was an option trader, and I discovered that volatility was indeed volatile. Back in those days, we thought volatility was a fixed quantity, like the house is blue or the
Hmm.
IBX beta is 1.2. Um, and one day I copied a formula for standard deviation down a price column in spreadsheet. I saw that volatility was changing, and I thought that that could be a way to set the bandwidth uh, automatically. It turned out that it was in the air in the very early 80s. Everybody was starting to realize that volatility wasn't the fixed quantity we had previously believed it to be. And in fact, the Nobel Committee ended up giving a Nobel Prize to Robert Engels for his work on volatility on inflation data. Um, and that's the origin of those models, Arch models and Garch models, and such like that. So that's how I got to Bollinger Bands, and they worked as originally specified, and they work the same way today. But what I discovered over the years, which would be most of interest to you, is that volatility was cyclical,
Hmm.
not in the way normal people think of cycles, and with a nice smooth sinusoidal shape and a regular time period. But volatility was cyclical in that high volatility was a forecast for low volatility, and low volatility was a forecast for high volatility. So it was rather than being mean reverting, which is how a lot of people think about security prices, such like that. Volatility is actually extreme seeking. It either
Hmm.
seeks to very high levels or very low levels, and that tied right back into that cycles work that I had done when I first started um, learning the business. One of my great moments, I went back east at the time, the Market Technicians Association, as it was called then, um, was hosting the Cycles Library.
Hmm.
And I remember to this day, the day I walked up to Wheeler and Shirk's great big cycles book, the big green monster cycles,
Yes, yes.
and started leafing through it. I spent hours and hours and hours leafing through it, and was astonished, just astonished by the work they had done. This is all done by hand, and under the most arduous circumstances on columnar pads with pencils, and later on they had calculators, but in the beginning they actually did the math by hand too. So
It's incredible. It's incredible, isn't it? I mean, we have that green book in our archive, and we also visited that. It's fascinating. Yes.
yeah. So that was a real thing for me. So I've always been interested in cycles. I mean, I suppose my interest started like any kid's interest starts. Um, the changing of the length of the day over the year, the cycles of the moon, the tides. You know, the winter versus
So
summer. All these things. You see all these cycles around you, and you start to think about them. You start to think about the effects that they have and such like that.
that's
So I think my journey is probably a very very typical journey of somebody who's noticed cycles around them.
yeah, yeah. So maybe getting back a little bit to your adaptive method, you described using volatility those days and trying to use volatility and then standard deviation based on that to derive the width of the bands, and that was the approach by that day you mentioned. We also in the foundation are thinking of ways to improve technical analysis on different indicators. Because one main concept of every technical indicator and also your Bollinger Bands is you need to decide for a specific length for the calculation. So
Mm.
the average you use a 20 period average for the basic calculation or whatever, or an RSI 13, 14, whatever. And I mean, I don't know how you think, but most people never questioned how to set the right length. It's one of the most important parameters to get your technical indicator right. But what about the knowledge to set the right length parameter? So you decided or you recommended the length of 20 in your main knowledge. And we have found that there are different ways also to use cycles, to use also an adaptive length based on the dominant cycle
Good.
instead
So
of a fixed length. What do you think about that?
I think it's a terrific idea. So back in the day, the 21-day moving average. I chose 20. I'm not sure why. It was 4 weeks of trading days or something like that. But 21 was a very commonly used length for stock market work and market timing work. And I always ask people why that was. And the explanation that I got that seemed to make the most sense is that it was based on the lunar cycle. So I don't know whether that's true or not, or whether it's coincident or not, but I always found it interesting, and that's been ticking away in the back of my head. And I remember Jim Tillman's work was so interesting, and so many other people who have done work on cycles. Chris Carolyn, Bill Cerubi, some of these guys have done just fantastic work on cycles. Chris Carolyn's tide work, it's just really super interesting. I think the idea of finding a cyclical component in the data and using that to set the length of the indicators you're using, as you've done in your work, is a terrific idea. And I think we'll be hearing a lot more about that in the future.
Yeah, I think it's a little bit of lost knowledge in technical analysis, and we want to bridge a little bit that gap, bringing knowledge about cycles and how to use cycles also across the group into the technical analysis community. Because what we found, or my specific analysis, was you can improve the RSI by using the dominant cycle length to adapt the RSI setting, and it improves by a huge margin the readability of that indicator. And as you said, I mean, there could be an rhythm introduced by the sun, the moon, or whatever. I mean, we don't know the root cause, but if we can observe that length in a data series, for sure it makes sense to tune to that rhythm, and then have our indicator adapt to that rhythm.
So for me, not knowing the root cause has always been somewhat of a problem. It's something that I think about all the time, and I've been attracted to many cyclic phenomenon where we have some idea of the root cause. Day of the week, for instance, some stocks are weaker on different days. Days of the week. The market has patterns over the days of the week. It has patterns over the hours of the day. It has patterns over the days of the month, and it has patterns over quarter end and quarter beginning, as well as annual patterns and 4-year patterns that are function of the political cycle. So for each of those, that you can sort of speculate that there's some sort of motive reasoning, and I find those easier for me to digest and understand and deploy in our work. I used to have a website called Pattern Trader that delivered information about all of those ideas to help traders. And what I think of it in my work is background information or environmental information. So it helps us figure out which way we're going to bias our operations.
Yeah, I think what you talk about also seasonal cycles, right? So different perspectives of the year, or different 4-year cycle, or even weekly cycles, daily cycles, which get into the seasonal type of cycles. I think there are always those two groups. I mean, with digital signal processing coming from an engineering perspective, you don't need to understand the root cause. You can just measure if there's a cycle or not. So,
but don't you wonder about it? Don't you?
For sure, for sure. That's the fascinating part. I mean, the data speaks for themselves. Yeah, it's just pure engineering, mathematics, signal processing. But then the other question is, okay, what is driving that cycle? Where's that rhythm coming from? That's what data is not telling you.
How do it do that, right?
and that's then really a type of science where a lot of research needs to be done, and there's a lot of unknown in that area, and there's huge information gap we have. So that's why we all need to bring our ideas together to better understand what is the root cause for those cycles. I mean, that's the holy grail. If we can explain those rhythms, that's fascinating. But getting back to your, as you mentioned, your patterns, and you also have that method that Bollinger Bands are used also to identify patterns or to better spot patterns in price information. And now let's talk about that patterns in price is what technical analysis, your indicators are also designed for to easier spot. But cycles are working on the time dimension, not on the price dimension. So, and we think, or I would be interested what you think about that, so that combining the information what cycles can give you, timing, when to expect a possible top or a possible bottom in terms of time, not in terms of price, and then combine then with a price-based perspective of a pattern, a topping pattern and price information, or a bottoming pattern and price information, if that appears on a point in time where a cycle has a bottom and then a price pattern was also in alignment, maybe visualized via the Bollinger Bands, wouldn't that be a match in heaven, to combine cycles and timing? And
that's exactly what I meant to say when I mentioned I thought of them as environmental information, so that you can bias your operations. If you feel that an important cycle is bottoming, and you see a bottoming pattern in relation to trading bands, then you have a higher confidence in
right.
executing. I think that could be really interesting. It's interesting that the pattern trading aspect of Bollinger Bands came later. The first thing we tried to do was compare price action within the bands to the action of an indicator, like an accumulation distribution indicator or a supply demand indicator. So if we tagged the upper band and one of those indicators was negative, we would think of that as a sell alert. If we tagged the lower band and one of those indicators was positive, we would think about that as a buy alert. I wonder if couldn't do the same thing with cycles. If you tag the upper band, and a cycle is turning down, then you would take that as a sell alert. And if you tag the lower band and the cycle was turning up, you could. That's work that I haven't done, but I speculate that could be a really interesting area for study.
Yeah, that's the path we try to take to combine technical analysis, which is, to be honest, an 80-90% price-based analysis, not time-based analysis, and to combine that with cycles from a timing-based perspective. And exactly what you phrased as environmental information, this is what cycles can give. And this is what we try to plot together on a chart. That's where we as Foundation now are heading forward, to bring both information on one screen. So right now you have often two applications.
So it's interesting. Most technical analysis is done on a monotonic price scale, but it's not always been that way. Back in the 30s, many people put volume on the x-axis. We have the work. I have a fantastic. Let's see if I can see it. Yeah, here it is. This is a chart book from the 1930s done by Edward S. Quinn, where he puts volume on the x-axis instead of time. So I think that exploring different domains on the x-axis could be super interesting.
Yeah.
The way I got to where I am today was by recognizing that something that was commonly accepted was wrong. So my recognition was that people believed that volatility was stable, right? For example, in options trading, if you wanted a volatility estimate, you just took half the 6-month range, right? And you didn't bother to update that, right? That was just a good volatility estimate because you thought that the quantity was stable. My insight was the volatility wasn't stable, and that it could be used in unique and interesting ways. So, questioning what's on the x-axis and how we deal with the x-axis, and
Yeah,
you
that's.
know,
I mean, there
I
was a
think that's really
time when there was a time when you mentioned volume-based charts, right? So the x-axis is plotting increments in volume and not in time. So doing that, it would allow us to detect cycles in volume.
hmm.
So which
And
could completely deviate from a timing objective. But if there's a rhythm in volume up and downwards, it's a different pattern. Yeah.
I think that I don't know, with all the automated trading that we have today, if the volume data has become too noisy. But I've always been fascinated by the idea of volume cycles.
Hmm.
I've never done anything about it, honestly, but it is something that I have thought about at length.
Yeah, we did it, but there was not a big community around that who was interested in that. I mean, but as you mentioned, maybe it's a lost area. It's not the common sense. Maybe it's worth paying more attention to those areas
Yeah,
again.
I think when things are accepted as granted, it's just as facts. Uh, um, Smart people, thinking people will want to question that. So there's lots of things that we think of today as facts about the market and such like that probably are wrong, and that by turning them on their heads, or seeing how they're wrong, we can make tomorrow's innovations. I don't know exactly what those might be, but
But
you know, I'm sure that there's some 18-year-old out there looking at a chart going, why do they do it that way? Wouldn't it be more interesting to do it this way? And
yeah,
that's going to be the big name. That's going to be the big name of the next 20 years.
it is, and I mean, we also can challenge why do we think that time is always linear? No? So also time, maybe we always plot it as a linear scale. So there are also different things to do with that.
Well, I can tell you that as a guy who's getting a little older in life, time, it doesn't seem to be too linear to me.
Right? Time is not linear that way, so maybe there's
Yeah.
also something in that. So, but maybe, I mean, we try to find ways to improve technical indicators. Let's get back a little bit, just for a moment, on your Bollinger Bands. So you use the standard deviation to have that adaptive width. What do you think? I mean, today, and you mentioned those days back, you didn't have the computer tools to use more sophisticated approaches than that. Thinking or starting today with your same approach, would you think, and cycles detection is really not a big thing these days. So using a cycle detection approach where we can measure the amplitude of the most important cycle, and using that amplitude as also measurement of volatility, and using that then for the width of the band instead of a fixed standard deviation and pattern. So starting these days with computer power, would you think that makes sense to even improve your Bollinger Bands?
Of course it would. One of the things about having created Bollinger Bands is the joy of all the wonderful ways people have taken them and made them their own.
Mm.
I've seen very short versions of Bollinger Bands. I've seen very long versions of Bollinger Bands. I've seen Bollinger Bands with every type of average that you can imagine used as the median point. I've seen population standard deviation, which is my choice, but I've seen sample standard deviation used. I've seen people compare average true range to standard deviation. I've seen I just seen tremendous amount of innovation around this basic tool, and for me, that's a great joy. To see
Okay.
people, pick them up and run down the road with them. The way I do and what I do is fine for me, but it's a big world, and there's a lot of people out there, and there's a lot of things to be done, and a lot of different markets to work in and think about. So uh, anything
So
that can improve the results for people, I think is a great idea. I'm expecting you to teach me how to adjust the band length with cycles.
So in New York, we will talk about a cyclic tuned Bollinger Band version, and we will spend some time on discussing that. But I will never teach you. You will teach us, so we will learn
No,
from
no,
you.
no, no,
So
no, no,
that's
no. The day
that's
you
not
stop learning is the day you start dying. So
that's true. I mean
I am
that's
anxious
true.
to learn.
That. So let's meet in New York, and then maybe it's a good point to come to the conference now. So I will promise you to bring a version which is a cyclic adjusted Bollinger Band version, and then let's have a discussion on that in New York. But what to expect from your end? I mean, you will join us at the conference. You will be a key speaker for one day. So you will be around with us. So can you lift a little bit the curtain, what you want to speak about in New York?
Now I'm going to speak about my experience with cycles. Some of the people I already spoke about a little bit about it. Gave you some hints. I talked a little bit about Jim Tillman and some of the early cycles people that I knew and liked. The impact the
Hmm.
Green Book had on me and such. I'm going to talk about a little. I'm going to talk about a little program that I wrote that combines um, cycles. I wrote this forever ago. I mean, literally in Microsoft Basic, right? But I wrote a little program that combines three cycles and demonstrates the Elliott wave pattern as a
Uh-huh.
summation of three cycles. So I'm not only I'll show that program and I've got a nice little interactive version of it, but I also give it away to the attendees so they can take it home and play with it.
Oh,
It's a little Python program, so
great.
they can put it on their laptops and play around and see how cycles interact. And you can it's quite nice in the fact you can adjust the magnitude, the duration, and the phase of the different cycles so that you can see how they combine. So, for example, if you think that a head and shoulders pattern
Mm-hmm.
is a product of several cycles interacting with one another. In this program, you can do that, and you can add drift to boot because at least in the American stock market we have long term positive drift. Um, so I allow that as a factor, and so I think it'd be an interesting tool for people to explore. And it's a little piece of open source software that I wrote um, that I will give away at the conference.
Great. That's nice. So we get a Bollinger Cycles playbook there for everyone.
Yeah.
That's
Oh, that's great. I'll call it that. I'll call it the sandbox, the cycle
yeah.
sandbox.
Yes,
You know,
the
it's
Bollinger
just
Cycle Sandbox.
yeah.
That's a good teaser for the conference. So for everyone who wants to join, I mean, it's an open conference, so it's not a closed shop. We will be around 100 people there, person in person. So last year was a great experience. We have been over 100 people. By the way, Chris Carolan will also be there with us again. So it's 28th of May to 30 May in New York City, Cycles in the City. So the link is also here in the video below. It's open for registration right now. We have some places left. So if you want to attend, if you want to meet John, it's a chance for everyone to join us. And as you said, John, it's 3 days really gathering in person, and the talk on cycles and the experience, even in the breaks behind the scenes you get with the attendees is really outstanding. So and it's really great to have you there also this year. Thank you for coming.
Oh, my pleasure, Todd, entirely. I love these conferences.
Yeah,
Um, any chance I get to meet and greet other practitioners and talk about what we do and how we do it is a great opportunity for me.
cool. So thanks for your interview and your time to at least learn a little bit on your thinking and thoughts on cycles. And I'm pleased to meet you. And then we will continue this talk on cycles and technical analysis. And I mean, we could even continue right now, but I think we need a place to find a break here for today. And then let's get move on in New York City.
See you
So
in
thank you
May.
for today. See you in May, John. Thank you. Thanks, everyone.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
Foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.